one piece of advice to a lawn care business owner is to make sure that you have a good CPA. And I would consider somebody that was executing your tax return, getting all your documents and filling out the return. But what I prefer is more of a value-driven CPA. And they're not always the cheapest, but being a business owner, you have ample opportunities to try to reduce your tax burden well within the code. So a CPA is integral to that execution. And I am a CPA, but we don't do taxes, but often we have a Rolodex of folks that we can recommend to people to work with. So that's basic first step that can be very impactful.
Today on the program, we're going to talk to a wealth advisor, Nick Bartolo, and I came across him on Jonathan Potoshnik's content. And I was like, if he's hanging out with JP, this guy's got to be wise. So I reached out to him on LinkedIn, and here we are. Welcome to the program, Nick.
Hey, Paul. Thanks for having me. It's good to be here. Great meeting you too.
Yeah, you too. I want to know how you met JP. How in the world did you end up in Jonathan Potoshnik's beautiful home there in Texas?
Oh, well, yeah, it's kind of like, I guess, one of these, new age ways of meeting somebody. So Jonathan and I were actually guests on the same podcast. So the biggest pest control podcast in the industry is called the Boardroom Buzz. It's actually a podcast that I co-host now. But back, sometime in late or let's say mid 2023, Jonathan was actually on the podcast a few episodes before me. So when I was checking out that podcast, I listened to JP's and I was like, man, this seems like a guy that I should reach out to, try to get to know a little bit, because as you know, I mean, you know him far better than I do, but very interesting guy, great entrepreneur, curious person, knows a lot. And so I just reached out to him on LinkedIn, and, we've been getting to know each other over the last year. And, the thing about Jonathan and I is that we kind of have mutual interests, but have specialties in different aspects of business. And so when he and I get on the phone, it's like, hey, you got, like 15 minutes, you have 30 minutes. Next thing you know, 2 hours later, we're still on the phone on 5 different tangents. So that's been a lot of fun to get to know him.
And how did you end up in his house? Because if I remember correctly, I was like, you're in his office. Is that correct? Or did you?
Yeah, that's correct. So I was actually in Texas for the state pest control association meeting that they had. I think it was, sometime this summer. And so, knowing Jonathan and knowing he was, based in Dallas there, I just reached out to him. I said, hey, let's get together and, see what we can cook up.
It's fantastic. His house is beautiful. And he wanted us to, we recorded, my buddy Naylor, we recorded some podcasts, and he's like, you just want to do it in here? And we saw his backyard, and we're like, no, let's do it in his backyard, man. His backyard's epic. It looks like you're in Europe. And I don't know if he took you back there, but for us who love landscape, and his backyard is one of a kind.
Yeah. No, I made him give me a detailed tour of the property. Just kidding. No, I didn't. We pretty much only were in a few rooms, but you can definitely tell that he and his wife have great taste.
Yeah, I did ask for the detailed properties. Like, you
did. Yeah.
You gonna show me the gym, JP? Because he told me at the gym in there. You didn't see the gym?
I didn't go check it all out. We had a little bit of a limited time schedule as well. So, we kind of kept it to just hanging out and, trying to add some value with some content for his new channel.
Awesome. Well, his gym, if you ever get back there, he's got a gym in his house that's pretty awesome, and a sauna and the whole nine. I was like, man, this is awesome. Well, explain, Nick, a little bit more about your background and how you can add value to someone who's a lawn care business owner and maybe thinking about selling their lawn business one day.
Yeah, thanks. Yeah, I mean, I'll try not to go back to birth or whatnot, but so I sort of came into this business. So I run, a wealth management firm, Essential Partners, and we're an SEC registered independent investment advisor. Okay. And so folks that typically have my seat in, owning and running one of these businesses, they typically come up through sales. So graduate undergrad and then basically try to bring business in over time to, add value to whatever big firm they work for. And obviously no disrespect to sales. I mean, sales runs the world, right? I mean, that's the name of the game when it comes to entrepreneurship and business. But my background is a bit different in that I went a much more technical route. So I started off as a CPA, actually, majored in accounting and did that. Yeah. And then I got sucked in, Paul, to be honest, to what I call the OG tech bubble, the original, internet bubble back in 1998, 2000. So I became really interested in investing during that time when I was, I was busy being a CPA, auditing public companies, which was, like pulling your eyes out, and got really interested in investing and realized that you could actually do that for a career. So worked for a big money management firm for a few years in a management development program, and then I went back and I got my MBA. And after that, I was lucky enough to be able to help manage money for large institutions. So this would include, like pension funds, endowments, mutual funds. And really what I did was that I would basically be the guy who's researching companies and trying to figure out which companies we were going to buy, either their stock or their bond or fixed income. And I got to do that around the world. Okay.
Wow.
So it really wasn't just like this kind of asset allocation education. It was really more of a steepening in education and business, because I got to travel around the world, meet with CEOs, CFOs, oftentimes of some of these great consumer oriented businesses that we've seen grow here in the US. And, it's a detailed job. Like you're building financial statements, you're understanding country dynamics, where the industry's going. And by doing that, you really have to understand how capital flows, how markets work. And so I guess really after doing that for 17, 18 years, I decided to start my own business, right? I mean, I'm a big believer in entrepreneurship and controlling your own destiny and just, trying to add value to other people's lives. I think that was, Steve Jobs' definition of business, adding value to someone else's life. And so now I, manage money and try to mitigate taxes for home service business owners.
And I definitely want to dive into the details of all of that. What's your investment philosophies and how we should be investing as we're growing our businesses, when we sell our businesses, tax mitigation. I have a lot of questions I want to ask you, Nick, but before I get into that, when you were researching these companies, what were you looking at? How did you know this is a company that we should invest in? Like, what were those indicators as you were doing all that research in your previous career?
Mm-hmm. So I can give you an example. I mean, so one of the companies that I researched, and this was way back in 2005 or 2004, 2005 timeframe. I could give you a handful of companies where the firm that I worked for at the time, which was called TCW, Trust Company of the West. We were either the number 2 to, let's say, number 5 shareholder in some of these big consumer companies. One was Starbucks. Another was Amazon.
Wow.
Monster Energy was another one where we had a big position. So these are all, household names now. But at the time, people really questioned the viability of Amazon as a business and whether or not you could actually be this everything store, not make a whole lot of money, but continue to grow your revenue to try to address like a really large market. So that's, frankly, that's a great example in that analyzing Amazon, you were really analyzing what their customer value proposition was, how they could address that, and what's the total addressable market of the areas that they were trying to sell into. So, retail and consumer products is one of the biggest addressable markets, in the world, really. And what was fascinating about Jeff Bezos, and I, really, it was very fortunate and humbling as like a 28-year-old, 29-year-old guy to travel up to Seattle and be able to meet with Jeff Bezos a few different times, just like with me, another person in my firm, and then Jeff Bezos, which like now looking back, like I feel, I mean, that's like, it's absurd. I had no place being in that room at that age, but I was lucky enough to do it. But, really understanding how a company like Amazon was orienting their business model around trying to capture that opportunity. And really what Bezos was trying to do is, and this is true for a lot of historically significant founders, is that he wasn't trying to necessarily design the business model around how he saw change happening in the world. He was actually trying to design the business model around something that wouldn't change and factors that don't change, which is one, customers' desires to have the lowest price possible, and also any particular person's desire to have a high amount of convenience in how they're receiving those products. And so if you think about Amazon's business model, that's really what they've done. they haven't necessarily adapted to all of the technological change in their retail business, but they've really just catered and pressed on those factors that Mr. Bezos knew are highly unlikely to change. So that's just like, kind of one example of some of the things that I worked on. But again, Paul, it was like you're building detailed financial models in Excel. You're modeling all the different factors at a really, detailed level to try to arrive, at a sound conclusion on any given investment.
So tell us a little bit more about 28-year-old Nick going into Jeff Bezos's office or conference room or wherever you met. What was that like?
So I grew up in Las Vegas, okay, very far from Wall Street. And my parents were high school teachers. And you probably didn't think I was going to go there and asking that question, but I hadn't been in rooms like that or around people like that growing up, like many folks who end up in those jobs and in those rooms are. So frankly, I wasn't overconfident and really just kind of approached that with a lot of humility and preparation because that can be a very intimidating experience. Even if you've got an education, you've been around CEOs before. I mean, can be a pretty overwhelming experience. So really, I would say though, it came with a lot of preparation and a long question list to make sure I knew where the conversation was likely to head.
That is very fascinating, Nick. I wasn't expecting that in your research. Just go have a meeting with Jeff Bezos.
I wasn't expecting to talk about it. I don't think I've ever talked about that publicly, but that was definitely a great experience.
That sure sounds like it. Well, tell us a little bit more about, you mentioned you transitioned, you got the CPA, got the MBA, was working, for those big companies, but then you got the entrepreneurial bug and started your own business. Is that correct? Tell us about your firm.
Yeah, that's right. So my firm, Essential Partners, I'm the 100% owner of the firm, and really I wanted to have more of a direct relationship with the people that I was trying to help. And when you're managing money and helping to manage money for institutions, it doesn't really work that way. Like you might be managing, your firm anyway, like $1 billion for the Texas teachers pension, but you're not actually like meeting with teachers and seeing, the impact that success in your investments could potentially have on people's lives. But as a wealth management firm, you have a very acute view of the impact of what you're doing could have on somebody's life. Okay. And so I also wanted to build a business just, for my family, just selfishly, right? Like add value to other people's lives and hopefully some of that accrues back to you. Mm-hmm. And so now what we do at Essential Partners is really, we focus very tightly on this home services niche, whether that's pest control, whether it's lawn, whether it's, roofing, gutter, fire safety, those types of, trade industries centered around home services, because we found that really, if you're focused on one particular group of people, you can much more understand the needs and the issues that come up over and over and the problems that you're essentially trying to solve for that group of people, which then allows us to design our services to just add as much value as possible to those folks. So really, that's how the wealth management firm is oriented. And it also leads, I think, and I don't, I guess I don't have a lot of experience studying a lot of other wealth management firms, given that I started in the institutional area. But I think we do have different services because of the actual types of business owners that we help. I'll give you an example, if you don't mind. So one area that we help folks is business sale analysis. Okay. So that's like, might sound like some technical jargon, but as you know, Paul, and we've chatted about briefly in the past, is that there's obviously a lot of acquisition activity in lawn and pests and fire, et cetera. And so what happens is these business owners, they'll get a valuation, from an M&A advisor like Potomac, for instance, or they'll get approached by a private equity firm and they'll just get, an offer to sell their business. And they see this offer or they get this valuation and they're like, well, what do I do with this? Right? Like, should I sell? Like, what does this imply? Like, what multiple? You've probably heard this, like what EBITDA multiple am I being paid for my business? And so it's really like taking that information and translating it quantitatively to be able to help them make a better decision or a well-informed decision about selling their business. So for instance, if a lawn business owner is being offered, 10 times EBITDA or 10 times cash flow for their business from a private equity firm, what happens if they continue to grow their business, let's say 10, 15% over the next 3 years, but now all of a sudden the valuation multiple that they're being offered is 6 times EBITDA, right? So actually like going through those scenarios and modeling it out. So that way they have the information. It's like in hard numbers and not just these like thought bubbles that, you've been a business owner, you're a business owner, Paul, like you have these, thoughts in the middle of the night and you wake up and you're like, oh, what if multiples go down? Instead of actually modeling it out so you can really understand what that means and how that translates to your financial life given a range of outcomes. So that's one example. Yeah.
Yeah. I've been enjoying binging you and Paul's videos. I was actually just out at the pool it's afternoon here where I live, but I was listening to you and Paul talk about tax loss harvesting and the SP 500 and all this stuff. And someone walked up to me and like, what are you listening to? And I told them, and they're like, okay, I wasn't expecting all that.
Yeah. They're like, how's your nap?
Yeah. It was a very attractive woman. She walked over to me and she's like, you look like you're deep in thought. And I was like, yeah, I'm listening about tax loss harvesting and the S&P 500 and all this stuff. And she thought I was joking, but that's what you guys were talking about.
Yeah.
Very interesting. We're seeing, and JP talks about this a lot of crazy offers in our industry right now. The highest it's ever been. So if somebody got the offer and can they actually like reach out to you, Nick, or like what does that look like? Are you accepting new customers or?
No, absolutely. So, as I mentioned, like our very specific niche is home service business owners and really those that are likely to sell at some point. Okay. And that sale might not come for 2 or 3 years, which you can do a lot of effective planning if you have that type of time, just from a tax mitigation standpoint. But yeah, so we will help those types of business owners if they're, approaching a sale in a couple of years, if they're about to embark upon a sale, or if they've already sold their business and they need help mitigating taxes and managing the money. I mean, those are the types of people that we work well with. Okay. And so, the folks that might not be as good a fit would be some of the earlier business owners that are still, just getting started. They may be mid-career. And I know like it's tough to build one of these lawn businesses inch by inch. You have cash costs, you're trying to build up your equipment, hire good employees, and you might not have a lot of extra cash flow left over that you're not putting into your business. And so really what we try to do is we try to get out publicly, whether that's through, forums like this, Paul, whether it's through, education platforms, Pest Daily is one that we've done modules with to really try to bring that education to the earlier business owners in thinking about some things that they could do early on. And, I go out and I speak at some of the state associations in order to try to spread that gospel of planning early when it comes to, your retirement and creating other diversified wealth streams, outside of your business. So, we do try to add value and give back to the community regardless of the phase. But when it comes to clients, really we're working with folks that at some point, it doesn't have to be today, but at some point in the future are likely to have a business sale because really, that's who we can add the most value to.
I understand, Nick. I want you to speak into somebody's financial situation. They're building the lawn business. You address that as we're growing, we're bringing on new team members. We're, bringing on new lawnmowers, power equipment, trailers, all of those things. But what percentage of our profits or, what amount of money should we be investing into the future? And what does that look like? Is that a simple S&P 500? Is like what is your recommendation to somebody who is a small business owner in the lawn care business? Not just the money. They know what to do with getting the equipment and the employees and all that. But I'm talking about outside of your business. What's your advice to a business owner?
Yeah. I'm glad you delineated that at the end because guess what? Like, just like the lawn business owners probably aren't, necessarily as experienced as an investor. I certainly can't run a lawn care business. Okay. And so I think I would even broaden the topic out, Paul, to be honest, because I think there's different mechanisms that can be impactful for a lawn care business owner. And it's not just trying to delineate how much they're taking out of their business in any given year to invest, but it's just like financial management in general. Okay. So one example and one piece of advice that I always try to give to, a lawn care business owner is to make sure that you have a good CPA. Okay. And so it's like, great, Nick, what's good? Okay. My guy does my taxes. Okay. And that's great. And I would consider somebody that was, executing your tax return, getting all your documents and filling out the return. I look at that CPA as more of a compliance or execution driven CPA. But what I prefer is more of a value driven CPA. And they're not always the cheapest, but you're most likely to get far more value from that type of CPA, all within the IRS code. We never recommend anyone work with someone who's going outside of that. But being a business owner, you have ample opportunities to try to reduce your tax burden well within the code. So a CPA is integral to that execution. And I am a CPA, but we don't do taxes. But often we have, a Rolodex of folks that we can recommend to people to work with. Okay. So that's one like really basic first step that can be very impactful in that relationship. Okay. And just again, to your question of what they can do, like in that relationship, that CPA might recommend, if you have a family, if you have a spouse, how about you put those folks on payroll? Okay. This is well within the tax code, and have them do remedial office tasks. Maybe not your spouse, but your children. Okay. And it could be appearing in social media ads. It could be appearing in other marketing collateral, taking out the trash, whatever the case may be. Okay. And so in the case of children, you can pay them $14,600 per year without them actually having to file a tax return or pay any taxes on that. But yet that amount actually increases the expenses of your business, which if you're a cash taxpayer can really reduce the tax burden, by the percentage of tax that you're paying. Okay. So, you have a few kids, man. I talked to a few LDS folks last week. They both had 5 kids, 14,600 a piece. Like you're starting to make a big dent into the profitability. All right. And then with that money, you can actually use it in a few different ways. You could set up a custodial Roth IRA account for the children to really get them started on their retirement. If that's, part of your philosophy. If not, that's fine too. You could even start a college savings fund for them if you're, interested in them attending college, or if they're interested in attending college. And I think, man, we all have sort of conflicting views on that these days, but this is just another, idea of how you then can create more tax deferred accounts for your children. And when it comes to your wife or your spouse, I mean, you can do something similar. They can be on payroll, which again increases the expenses of your business, so lowering the tax burden. And then let's say you have a company 401k or a simple IRA for the company. And we can talk in detail about what the differences are between those. But being able to not only put your spouse on payroll, but then have he or she contribute to that tax deferred retirement could be another effective strategy, whether they contribute, $16,000, which is the max for a simple IRA, or around $23,000, which is the max for a 401k. So those are a few of the ideas that I would have initially. But even to take one step back, like what are the most effective things that anyone can do, particularly a lawn business owner, is to start a Roth IRA. Okay. And most folks out there, they've probably heard of a Roth IRA, but they might not be contributing. Okay. You have to fill out the paperwork. It's kind of a pain at times, right? And so it's just one of those things that people tend to put off, even though they know that it's a good idea and that the earlier you start, the longer you have for that money to grow. So let me give you an example here, Paul. So a Roth IRA is an account where you're contributing after tax dollars. So you've already paid tax. It's not one of these, it's not like a 401k where you get a tax benefit or a tax deferral. It's actually after tax, you can put in $7,000 per year for you. And then if you're married, your spouse can also put in $7,000. Okay. And when that money grows, you never have to pay tax on it again. Okay. Which is a really attractive feature. So to put some numbers behind it, let's say, you and your spouse both contribute $7,000. So $14,000 per year. Okay. And let's say you're young, you're, 30 years old, whatever the case may be. And you do that for 25 years. So $14,000 for 25 years. And, actually that amount goes up every year, but we'll just keep it simple in this example. So if you put $14,000 in, and let's say your investment return is 8%, and you do that for 25 years, at the end of 25 years, between you and your wife, you have $1 million. Okay. And that's $1 million that you never have to pay tax on again. And you never have to pay tax on any of the profits. So that's an incredibly powerful account, which really, I know like you're sometimes folks in home services and lawn, like you're putting every last dollar back into the business. But if you can come up with $7,000 for you, $7,000 for your spouse, that can be an incredibly effective tool to build another nest egg outside of your business.
And can you explain, if you earn too much money, isn't there a limit that you can't put into the Roth IRA if it's like 170 or something like that a year? Explain that once, and explain the difference, Nick, between a traditional IRA, the Roth IRA, a SEP IRA. Can you break all that down for us? And remember, we're rednecks and trucks. We're not your CPA and MBA friends. Talk to us in Main Street language here.
I will. Those are my people. Growing up in Vegas, the thing about Vegas is that it was always the fastest growing city. And so all of my best friends growing up, it's like their parents have pool businesses, landscaping businesses, pest control businesses. And so that's my language. I ended up doing all this other stuff, but that's where I started. But so the differences between some of these accounts. So to your first question though, Paul, about the income limits. So, our government, they like to make things more complicated than they need to be. So besides wasting a lot of money in the government, they also make things much more complicated. So those income limits exist, but there are ways to continue to contribute despite those income limits, which a lot of people don't realize. It's called a backdoor Roth. Okay. And the way that you're able to contribute to a Roth IRA while still being above those income limits is that you have to have a zero balance regular IRA. And on day one, you contribute the $7,000 to the regular IRA. And then the next day you go into your account and you convert that to a Roth IRA. And then you're allowed, despite the income limits, to be able to contribute to a Roth IRA. And despite that headache and hassle of doing that, the IRS has actually blessed that treatment. So they've said oh, no, that's okay. You can do that. But for some reason, they keep the income limits there. So that's just one of these peculiarities that they've created. It's bizarre, right?
I'm taking notes, and I want to make sure that I've understand this, because this is very helpful, Nick. I've heard this backdoor Roth before, but I just didn't quite understand this. So you're an income earner that's above the limit, which is I think is 170,000 a year.
It's around there. Yeah, it's around there.
So if that's your case, which thankfully a lot of our listeners, you guys are crushing it, and you're like, I make more than that, Paul. There's still a way you can get our Roth IRA. You open another IRA, which is a traditional IRA with $0 in there. So no investments in that account.
Correct.
Then I got lost. How you get the money?
So what you do then is on day one, you put the $7,000 into that regular IRA. So the non-Roth IRA. So you put it in there. But then the next day, you go into your account and you transfer that $7,000 into a Roth IRA. Okay. And it's just one of these weird rules that, the IRS allows, but it creates a hassle for people. And then from there, every year you just do the same thing. So you make sure you keep that zero balance IRA. That way you can transfer the money in there and then convert it to the Roth the next day. And you can do that once per year.
Okay. And you kind of lost me when you said day one. So we're in year 2024 right now, but what did you mean by day one?
I just, that's probably a, a bad way to phrase it, but on any particular day in that year, you make that contribution. Okay. You could do it at the end of the year is typically a good time for some of this planning. Some people do it right before they file their taxes, but on any given day in a year, you make that IRA regular contribution. And then on the next day, you transfer it to a Roth. And the reason you do it next day is because you don't want to invest that money in the IRA and then have it grow and then convert it to a Roth, because that can create, or it will create, adverse tax consequences. That's why you need to basically do it the next day into the Roth.
Okay. So from what I understand, your advice thus far, if you own a lawn care business, is, I'm looking at all my notes here. This has been so super helpful, Nick. Number one, if you have children, you can pay them about 15 grand a year, and then that will be an expense. And so your kid's getting money, but and equally your business is saving that, having that 15,000 as an expense. Number two, you need to invest $7,000 per, if you're married, per person. So 14 total if you have a beautiful wife, into a Roth IRA. And if you earn more than the limit, then you make a traditional IRA with zero balance in it, put the $7,000 in there, and the next day convert it to a Roth. Is that a fair summary so far?
Yeah, that's a good summary. Yeah.
Okay.
Yeah.
And now once the money goes into a Roth IRA, it's just sitting there, like ain't doing nothing. What do you do next?
True. So that's, look, I do recommend for folks, even in that, kind of early or mid-career business situation as a lawn business owner, I do recommend, if they can, find someone that they can work with, where that person or that financial advisor's business is suited to serving those types of clients, right? If they don't want to do that, or if they don't know somebody that they can, turn to for the investment advice, I do think at that level, it makes sense to just, find a low cost index ETF that tracks a broad basket of stocks, particularly if the person or the business owner is young. And, I typically would recommend something that's, either just tracks the SP 500, or even, let's say, something broader, because that's the 500 largest companies in the US. You could buy an ETF that tracks the entire stock market in the US, or even better, what I would tend to focus on is a index ETF that tracks all of the stocks in the entire world. Okay. And the US, as a portion of that mix, is still going to be, 65-ish percent, 70% of that index. So that's a really low cost, easy way to just invest that money, with the understanding that, yes, you are going to have substantial volatility investing in that index ETF, but it'll be low cost. And odds are, as global economies continue to grow, that your return, is likely to be respectable over a long period of time.
Do you recommend Charles Schwab, Vanguard, Fidelity? What one of these, or is there another one? What's kind of the most reputable one from your experience in the industry?
Yeah, so you mentioned all good options, Paul. So at Essential Partners, my firm, we partner with Schwab and Fidelity. Okay, so those I think are great options. Vanguard is another good option to just go direct with Vanguard. But look, those are some of the biggest financial institutions in our country. Like, we use Schwab and Fidelity for our client partners. They both custody or hold $8 trillion of assets. And, at my firm, the way it works is that all of our client partner accounts are either with Schwab or Fidelity. So it's not like, I'm holding the assets, Essential Partners is holding the assets. No, it's Schwab or Fidelity is holding the assets. So, like, our client partners always have a direct login to those institutions to actually see what their investments are, independent of, any client partner portals and our software applications that we have, which I've found just creates a lot more comfort and security in people's minds. But yeah, so to your question though, those are great options.
Okay, back to my original question. I'm taking all kind of notes here. I wrote down the questions that you wanted for me, but this has been absolutely great, Nick. So you briefly talked about the traditional IRA. I want a comparison here because people talk about a SEP IRA, a Roth IRA, a traditional IRA. What is the difference between all these terminologies, and what makes the most sense for a lawn care business owner?
Yeah, that's a good question. So let me break down a few things, okay? And I want to talk about the things that are most relevant to the audience. So the first thing to consider is whether or not you want to have a company retirement plan. Okay. So if you do want to have a company retirement plan, which is good for you as the business owner because it allows you to contribute pre-tax dollars into that retirement plan. And the main plans that I'm talking about as it relates to lawn business owners, one would be a 401k. And a 401k essentially allows you and any of your employees to contribute. I think the limit right now is 23,000. It changes by $500 or $1,000 every year. So I may be a little out of date there, but I think it's $23,000. So it's a company retirement plan. You as the owner contribute $23,000 and that amount is not taxed. Okay. However, when it comes time, when you're 60 years old, 65 years old, you have to pay tax, regular income tax, as you withdraw those funds because you never paid tax on it in the past. Okay, that's how it works. One complaint on a regular 401k plan for business owners is that they can be a bit more costly and there's some compliance involved. Although there are a lot of good low cost options now where it might only be $2,500 a year, which is not nothing, right? Like that's still a cost and it is material, but they're a lot lower than they used to be. Okay, so that's a 401k. And that allows your employees to make those contributions as well. And it also allows you to contribute to your employees' retirement, which I know for some home service, lawn business owners, that's a favorable retention tool that they use for their employees that really see the value in that. However, there's also something called a simple IRA. I'm not going to talk about a SEP because really, if you have employees, a SEP is not the right solution. But a simple IRA is often the first company retirement plan that I recommend and that home service business owners implement. And the reason is this, is that there's no cost to a simple, essentially. If you get linked up with Schwab, if you get linked up with Fidelity, you can open a simple IRA plan for you and your business at essentially, it's no cost. The difference between a 401k and a simple, though, is that the contribution limits are lower. So instead of $23,000, the current limit per year is $16,000. Okay, so you can only defer and contribute $16,000 into the plan for you and your employees. And then there's a mandated contribution that you make on your employees' behalf. So I believe, just going from memory here, I believe it's 2% of the total pay or compensation for each particular employee, or up to a 3% match of what they contribute. Okay. So the simple also has the provision that you have to have less than 100 employees, which, that's a lot of employees. So, the simple can last for quite a while and allow a company to implement that and go with that plan for a long period of time after starting up.
That's so good. Yeah, I appreciate you breaking all that down. You did say you didn't want to mention the SEP, but there are a few guys out there, we call them solo and proud. They go out and make a few $100,000 a year, spraying garden, doing fertilizer in a route density, a nice route in a close area. And it's just them. They're the only employee in the company. They're doing the labor and they're, because they don't have much overhead, they're making pretty good money. Would a SEP, would that make any sense for them?
It might, Paul, but what I typically recommend for folks that are solo is what's called a solo 401k. I hit you with another one here. So
I need to get a new sheet of paper here for my notes.
Yeah, I need to get some notes on this stuff. And so luckily this is probably being recorded, so we have that. But a solo 401k is a good option as well, in that it's not like a 401k in that it's costly. It's actually free if you open it, with Schwab or Fidelity, is my understanding. We do this for folks, for the clients that we help out. But what a solo 401k is that you not only get to contribute that $23,000, which is essentially your employee contribution, because essentially you're a one-man company. And so you're the employee. So you contribute $23,000. And then you can contribute up to a total of, I think the limit for an under 50-year-old person right now is $68,000. So, you can contribute another $35,000 above the $23,000 as like the company contribution or the employer contribution. So that's a really effective tool to be able to defer up to $67,000 and not pay tax on that. Okay. So if someone's making, a couple $100,000, $250,000, they make that $23,000 contribution as the employee, and then their one-man company makes the remaining contribution. And, if you have a 30% tax rate, that can save you, over $20,000. So that's a really effective tool. And then let it compound and invest it to contribute to a nice retirement in the future.
That's fantastic. So in my notes, if you are solo and proud, you could look into a solo 401k. If you have employees, look into a regular 401k. And Charles Schwab or Fidelity is some good reputable companies.
And you can look into a SEP IRA as well as a solo person. And, that could, given your circumstance, that could be a good option as well. It just depends.
Okay. Well, I know we got kind of in the weeds there on the Roth IRA, but I think it's very powerful, that math you shared with us, 14,000 a year. And of course that goes up a little bit every year. Over 25 years at 8% that's $1 million right there, just from, 7,000 doesn't seem like that much money, but it turns into $1 million over time. The good old compound interest. That's a Roth IRA.
It does. And, I like to give an illustration like that because it hopefully can motivate some folks to get out there and just make those, rather small contributions every year. When otherwise it's certainly, business owners, it's like you're a business owner. It's not on the top of anybody's list, right? They want to grow, they want to drive revenue. They're trying to find people, trying to increase their profitability. They're not thinking about Roth IRAs, but it can make a big impact long-term.
Got it. Well, I know we went in the weeds on the Roth IRA, but I want to ask you about your overall investment philosophy, Nick. How do you make people money? What is your philosophy for money management, wealth building, investing?
We might have to do a whole separate podcast on this one, Paul, but I'll try to keep it, I'll keep it pretty high level, right? Because ultimately when I'm helping folks, like they want to know, well, what am I actually going to be invested in? Okay. And oftentimes, depending on someone's experience level with investments, like it can all be just buzzwords, right? So what we ultimately do is we invest our client partners' cash in stocks. So this is, fractional ownerships of some of the best businesses in the world. We'll invest their money in bonds, whether that's government bonds, issued by the US government, or it could also be company bonds. So a company needs to issue debt in order to fund a project. They'll go out and issue bonds and we could purchase those or purchase those through an index. We also, somewhat unconventionally, I would say, we'll invest in commodities. Okay. And we could talk about why that is in a bit, and real estate and also private funds. Okay. And so private funds, they can capture any of those other asset classes, but they're just privately held or private, like they're not publicly traded, if you will. They could be partnership structures. They could be other legal structures, but they're essentially private. You can't just buy them in the public markets. Okay. And ultimately, by doing that, what we're trying to do is not only maximize returns, which everybody wants to talk about returns and everybody wants the highest return, but we're also trying to maximize peace of mind. Okay. And so everybody's situation is different in what that means to them. And, effectively, you can't have a good investment strategy without really understanding those personal characteristics of a given person. Because, if you have a lawn business owner that sells their company for $50 million, right? And they've been a really frugal person over time, their house is paid for, It's like, why are you going to go out and take undue risk and subject that person to tons of volatility when they're taking care of their kids and probably their grandkids? Okay. So you really have to like think about the personal situation and then design an effective investment strategy. Okay. So what most folks don't realize though is that, there are these different philosophies. Some wealth advisors, they have this very, I would say, generic and very long-term philosophy where it's like, we're going to invest all our clients' money in stocks. Okay. It's like stocks for the long run. Stocks have the highest return. You just have to ride out the volatility. Like, oh, don't worry about, potentially taking a 30, 50% drawdown or a decline in the value of your account. We just have to stick through it. And there is wisdom in that, but I found that can really subject people to just behavioral errors, or what I call cognitive misjudgment errors, to where you sell your business, you have this big pile of money, the market goes down 50%, and you want to sell everything at the bottom because you've worked too hard to let it all evaporate. And that fear-based portion of the brain takes over at that point, and you're cooked. Okay. And people also want to buy more at the top and let greed take over. So trying to manage that volatility is something that we do. So I'll give you a stat though. What most people don't realize is that in 3 out of the last 9 decades, US stocks have actually underperformed cash. Okay. Cash being just like short-term US Treasury bills, which, or just basically cash that earns, the rate of inflation or a little above. Okay. So in the 1930s and the 1970s, and from 2000 to 2010, you would have been better off just having cash for that entire decade. Okay. So if you sell your business and then you go 10 years because you're invested in stocks and earn no return, I just don't think that that's a favorable circumstance or outcome for our clients. Okay. So what we do is our foundational philosophy is something I call the core 4 economic environments. Okay. And it really tries to create diversification, not just between stocks and bonds, let's say, which most people, or most advisors consider to be diversified. It creates diversification to economic environments. Let me explain what I mean. So it's essentially this like 4-quadrant model, Paul. And the quadrants are defined by the rate of change of growth between economic growth and inflation. Okay, so I'll give you an example because hopefully that'll make it kind of like more come to life for people. So let's say in Q1 of 2020 when COVID hit, right? Like we all probably viscerally remember what that looked and felt like. Economic growth collapsed and inflation expectations also collapsed. Okay, so this is a deflationary environment. That's what that environment is called. And so if you owned a business, or if you owned a business via the stock market by owning a lot of stocks, the stock market was down 35% in Q1 of 2020. And you can imagine, like, if your business's revenue is collapsing, your profits are collapsing, like, in the short term anyway, the value of your business is going down, right? So it should be no surprise that, stocks were also down in that type of, environment. However, if you would have owned long-term treasury bonds issued by the US government, those were up 25% that quarter. Gold was up 10%, and inflation-linked bonds, again, issued by the US government, TIPS bonds, those were up 15%. So even if you had a small amount of your investment portfolio in some of those other diversifying assets, and again, diversified to economic environments, you're having a very different experience with your portfolio than someone who's all stocks and they're down 35% and they're wanting to, let fear take over and sell at the bottom. Okay. And so by having that diversification, you not only are not experiencing that drawdown, but it also gives you the opportunity to sell and rebalance some of the things that have gone up back into the asset classes, such as stocks, that are performing poorly. Okay. So there's 2 benefits really there by having, that type of economic diversification. And I could go through a bunch of other examples, but, I don't want people to fall asleep.
I'm taking notes here. Can you give us the bullet point list of the core 4?
Yeah. So
taking notes.
Yeah, so we talked about deflation, right? That's when economic growth and inflation are both going down. Another one, and I'll give you the example, is stagflation. So this is when economic growth is falling or not growing as much as people thought, but yet inflation is rising more than people thought. 2022, the year 2022, a recent example of this, where that's when inflation really took off, but growth expectations of the economy disappointed. Okay. So in that particular quadrant, this stagflationary environment, which was a big popular term in the environment for much of the 1970s. So again, I'll take it down to the business level because I think that resonates most with people, and it's like that first principles thinking. So if you own a lawn business and your revenue is not growing as much as you thought, but all of your costs are going up, right? Like everything that entails, labor costs are going up, like material costs, truck costs. I mean, people, they're listening to this, they experience that, right? In that environment, your profits compress, which is bad for the value of your business. And stocks, they're no different. And so the stock market in 2022 in this stagflationary environment was down over 20%. And so in that scenario, though, you want to own the things that are actually inflating or benefiting from inflation. And in this case, a broad basket of commodities was up over 20%. So that would include oil, copper, wheat, all of the kind of soft grain commodities, and then, more of the industrial commodities. Gold, which we haven't talked about today, gold would be another thing that would typically do well. Typically do well in that environment. Gold was flat, which isn't, shooting the lights out, but it's far better than a 20% decline in stocks. So that would be another of the four quadrants, Paul. The other two are really favorable towards stocks. One being a reflationary environment, and this would be more like 2021 as a recent example, where growth and inflation are rising more than people think. Okay, so stocks do well in that environment as revenue growth surprises to the upside, and commensurate with that, profits do as well. Commodities also typically do well in that reflationary environment. And the last of the four quadrants is when economic growth is rising, but inflation is falling relative to expectations. And that's really what, it sounds like it is an old children's fable, and it shouldn't probably be a Wall Street term, but it is. It's that Goldilocks environment, kind of not too hot, not too cold. So the economy isn't growing fast enough to really kick up inflation, but it's growing fast enough to be a favorable backdrop for businesses. And so stocks do really well in that Goldilocks environment.
Very helpful. I have all of that written down there. We have deflation, stagflation, reflectionary, and the Goldilocks. Is that?
Yeah, reflationary. Yeah, reflationary. And look, like this foundational philosophy, the idea isn't to try to move all the capital between, whatever box or whatever quadrant you think is likely to benefit from the current environment. I mean, there can be tactical changes, but it's really to ensure that you have, some investments in each of those four quadrants. So you can really try to dampen volatility, yet, try to earn a return, reasonably similar or better than stocks over the long term.
So I have written down here, Nick, you mentioned stocks, bonds, commodities, real estate. When you say stocks, can you explain what an individual stock is versus a mutual fund versus index? Like what you use the term stocks, but like what do you mean by that?
Yeah, that's a good question. Good clarifying point here. So when I say stocks, the way we typically, implement that or invest in stocks in my firm is through ultra low cost index ETFs for the most part. Okay. And what an ETF is essentially a collection of stocks. So most of the folks out there, they've probably heard of the S&P 500. Okay. What the S&P 500 is, those are the 500 largest companies that trade on the US stock market at any given time. Okay. So the tail of the 500, things go in and out from time to time. A company may grow in terms of its market value and not get included in the index for a number of months. So it's not real time, but S&P, which is a financial data company, Standard & Poor's, they have this index and it's the 500 largest companies. instead of going out and buying those individual companies, you can just buy what's called an ETF, which stands for exchange traded fund. So an exchange traded fund, it trades like a stock. So you can go out right now and just purchase an S&P 500 ETF, and you're purchasing effectively this collection of the 500 largest companies in the United States. So that's typically, how we will execute some of these investments, but that's just, I guess, more so like the surface level, Paul, because we also invest in private funds, which have more kind of detailed, idiosyncratic investment styles. But when I'm just talking about the core four and just mentioning stocks, I'm thinking more of like broad indices, such as the S&P 500.
Got it. So then you put your money in your Roth IRA, your $7,000 each year, and then it's just basically just sitting there on Charles Schwab. Then you have to kind of activate it to go into, we'll use the S&P 500 index as an example. You can put it in there, and then that way you're diversified rather than just sitting there in Charles Schwab. It's now kind of spread out across those top 500 companies. Is that a elementary way to explain it?
No, that's a great way to explain it. Yeah, it's a simple and perfect way to explain it, because so you go out, you're sitting there, the 7,000 is in cash, as you mentioned, and then you just go out and you place that one trade to buy, you could buy a BlackRock S&P 500 ETF, and the fee that you're going to pay on that to BlackRock is going to be like 0.03% or something minuscule like that. And then you can just hold that, right? And then every year when that money comes in, then you can just do the same thing, right? And so that can be an effective way to participate in the long-term growth of the U.S. economy and the business that are operating within it.
And can you explain what's the difference between the VOO from Vanguard or the IVV, or I think it's SPY? Like there's different ones. How do you know? It's like, what's the difference between these different little symbols, VOO versus IVV?
Yeah, that's a good question. So they're really the only difference is fees, right? So if you have something that's tracking the S&P 500 index, right, the only difference that you're effectively receiving from VOO is the S&P 500 index for Vanguard, I'm assuming, since you said that, versus like IVV, which I know because we do use that one for our client partners, is going to be the fee. So what we try to do is we try to use the one that has the lowest fee. What's fascinating, though, is that BlackRock, for instance, they have other S&P 500 ETFs. I think BlackRock does, where, they're older ones that were maybe started, in an earlier period when fees were actually higher for index ETFs. And they haven't like retired those and moved them to something different. They just launch a new one with lower fees. So you do have to be careful, right, to make sure that you are going out and buying the one that is likely to have the lowest fee now and into the future. But yeah, there's no difference.
So IVV is a good one. If you're like, I want to invest in the S&P 500, the correct ticker symbol thing is just IVV.
Right. That's right. Yeah. That's a low, I know that's a low cost one if you want that exposure or those investments in the S&P 500.
Okay. This is very helpful, Nick. What advice do you have for owners who are considering selling their business one day, whether that's next year, 2 years from now, 3 years from now? What should they be putting into order to get maximum amount when they sell it?
Yeah, that's a good question. So when it comes to an owner who's really considering selling, there's certainly different things that they need to consider. So when it comes to like what we do with those types of owners, there's really, let's say, 4 dimensions that we try to assist them in that process. We talked earlier about that business sale analysis. So really going through that quantitative sensitivity of whether or not they should sell and what type of scenarios are likely to lead to these different outcomes, right? So if I sell now for 15 or for 10 times EBITDA versus, let's say, multiples go down to 6 times EBITDA, okay? So that's one piece of the analysis. Another service that we provide is what I call just like cash flow forecasting or cash flow planning. So if you're a business owner and you've been receiving all of your income and all of your cash flow from your business and the profit that it generates, and you go to sell your business, you're entering a whole new world, because now you need that cash flow to come from your investments. And so if you don't know what your return is going to be and you don't know how the money is going to be invested, it's very hard to conceptualize that and to go into that business sale with confidence. And it's really essentially thinking about, if I sell my business for X and my return is Y% over time, a long period, what does that actually mean for my lifestyle? Is that going to be less money that I'm bringing in now? Is it going to be more? And so really trying to figure out how to think about that and what the investment strategy could be to be able to meet that lifestyle and those objectives for that business owner. That's like core to what we do. An owner who's approaching a sale, even in the few year future, like 2 to 3 years out, needs to start thinking about tax mitigation, because we do have tools in my firm in order to mitigate taxes on the sale through investments if you plan early. There's ways to do it, outside of investments as well, but starting early can be critical. But even if you don't start early, there's still ways that we can mitigate taxes on the business sale, which is something that we're like really focused on, because man, business owners, I don't blame them. And given the direction our government has gone in terms of running these huge fiscal deficits and all the inefficiency, big mission of mine is like protect home service business owners from unnecessary taxes, right? You work 20 years to build this business, and then to just give 20-30% away to the government in a business sale, it makes my stomach turn. And so that's a mission. But then the other core service of what we do for someone preparing for a sale is really investments and thinking about what an investment strategy is going to be long term. Okay. So that's what we do. But then in really thinking about an owner and them preparing for a business sale, I like to kind of turn that around and think about who's actually acquiring your business. Okay. So there's a number, as you know, Paul, there's a number of private equity backed lawn businesses that have been acquiring businesses in the US. Okay. And these private equity companies, what they do is they'll go out and they'll buy a big lawn business that will be their kind of platform to then acquire more lawn maintenance companies or landscaping companies, commercial, residential, whatever the case may be. Okay. And so when these private equity backed companies, when they're done doing all these acquisitions, they want to liquidate that investment. What do you think they do? They don't go and get wined and dined by a bigger private equity company to actually sell that business. They hire an M&A advisor, okay? Because trying to create a competitive process for your business when you go to sell it is critical. And also trying to manage all the legal aspects of the transaction, the terms and conditions, is also something where, I've seen, quite frankly, a lot of value be destroyed. And so, you mentioned Paul earlier, but we always recommend Potomac as being, the largest home service M&A advisory firm to really kind of shepherd people through that process, to make sure that they get the highest possible amount for their business, which we all want to see, and also to really mitigate the risk in the transaction. Because look, as a business owner, a lawn business owner, you're likely to have one transaction, and these other folks that you're on the other side of the negotiating table with, that's their job, man. They're doing transactions all day long, every day, and have been doing it for, tens of years, I imagine. Okay. So, you could ask Jonathan about that. I know he used an M&A advisor when they sold their software business, Service Autopilot. So, I always recommend folks get linked up with Potomac and Paul and Franco over there to really think about the nuances of their business sale.
Yeah. And I remember Jonathan talking about that, made a gigantic swing of having that representation.
Yeah. Because you know how it is. I mean, business owners kind of get wined and dined by private equity, and it's like they're good at building relationships, right? So you have somebody across the table from you, there seems to be a cultural alignment, everything seems great. But look, their job is to try to buy your business for the lowest possible amount, because that's what makes their private equity backed roll up work, so they can appease and satisfy their investors, because everybody has clients, right, where they're trying to generate a return for, and private equity is no different. And so it helps to kind of have that buffer to negotiate on your behalf.
I just looked at the clock and realized we've already gone 4 minutes over.
Not surprised.
Are you do you need to wrap things up, or
What do you think, Paul? What do you want to do? I mean, do you want to talk about there's some other things on your mind that you think would be helpful? And we can always do it again.
Yeah, this has all been very, very helpful. Again, I'm putting into perspective my friends that are out driving around in the truck right now. My brother's in your world to some extent. And I know you guys, it's two different people here. So you explaining it really, really the way you have has just been so helpful. And you did a really good job, Nick, of making things that are a little bit more complex just so simple to understand. But I was just wondering if there's anything in your investment philosophy that maybe you didn't unpack that you wanted to share. I feel like you did a good job, but if there's anything you think we're leaving out here, feel free to share, and then we could always have you back on for a part 2.
I mean, I think we hit on a lot of the key points. We didn't really talk much about some of the more, I guess, nuanced investment strategy, or, how impactful some of the tax mitigation can be. But look, like, we don't have to get into all those details. And frankly, some of that stuff is proprietary. But, obviously there can be a big impact on the tax side on a transaction in really implementing tools from the investment side that, these tools, like, they target market beating returns. But in some cases, you can reduce the tax burden on a sale by, 20% or more. Okay. Wow. And so that's just, can be really impactful for a business owner going through this, which ultimately leads to more money to make money with over a long period of time, right? Which is what we all want for these business owners.
And so if you are thinking about selling your lawn care business, did I hear you mention Potomac? Is that Paul?
That's Paul. Yeah. And Paul Gianamore, that's his company, Potomac. He works really closely with, another gentleman there called Franco Villanueva Myers. And so they do a great job and are huge advocates for home service business owners.
Okay. And then I know you mentioned off air your how much money you oversee in your business, and you guys do a lot over there. But what's like the threshold if you do have somebody wanting to hire a wealth advisor? Are you taking on any new clients? What's the minimum that you have to invest? Can you explain a little bit more about your firm and becoming a customer of yours?
Yeah, well, I mean, anyone out there can feel free to reach out. We're at essentialp.com. That's ESSENTIAL, P as in partners.com. And, please reach out with any questions, and you can, also be added to our newsletter. But yes, we are taking new clients on, and every situation is different, Paul. So I'm always hesitant to give any sort of minimum thresholds, because you may have business owners, lawn care business owners out there that, own a business doing $5, $6, $8 million, $10 million, but that owner is continually, or has been continuing, to reinvest in that business. So they might not have saved up, $1 million or $2 million or whatever the case may be. And so I never really use any hard and fast minimums, but, ultimately the folks that we work with are likely to have a sale at some point. So they may not have any money, 2 years before a sale or 1 year before a sale, but then they're likely to have a $5 million sale or up. So those are the types of folks that we tend to, work best with.
Yeah, shout outs to Andy Mulder. He's got a landscaping business up in Indiana, and he paid off his house, completely debt free. And he has big equipment too. He does lawn mowing, but he also does landscaping, big equipment, all paid for, zero debt anywhere. And then he just saved $1 million just sitting in cash. And he called Dave Ramsey. He's like, "What do I do?" He's like, "I paid off my house. All my equipment's been paid for. We have no debt, and I got $1 million just sitting in cash, just from doing landscaping and everything like that." So they came up with a plan to get him a little bit of real estate where he's going to build a shop on. There's a lot of guys out there that are equipment's debt free, and there's money saved up, and they're like, what's the smartest thing I can do with this $1 million? It's just sitting in an account.
Yeah, and that's what's hard, right? Because you're now in a world that, you haven't been operating in, and there's all types of strategies. I mean, one strategy that we've been investing in on our client partners' behalf are private loan funds. Okay. And so these are funds that are yielding around 10% currently. And essentially what it is, it's not like, investing with a loan shark down the street or anything. It's essentially these funds are funding private equity backed deals. So I'll give you an example. So let's say you have a private equity company that wants to acquire a lawn business worth $100 million. Okay. That private equity firm, what they'll do is they'll go out and they'll take $60 million from their fund and contribute that towards this $100 million transaction. But then the remaining 40 million, they'll borrow. Okay. And they'll borrow from some of these funds and that are backed by these large money management companies. Okay. So, so essentially what happens is I deploy my client partner's assets to a multi-hundred billion dollar money management firm. That money management firm then gives or loans the money to a private equity firm to buy lawn business. Okay. And then through that chain, my client partners are receiving 10% in return for making that loan. And what's interesting about that is that it's far less risky versus stocks. And if that lawn care business, this $100 million business, were to have some difficulties or substantially decline in value, those loans are actually the first loans to be paid back in the case of that business having difficulty. Okay. So you think about that and it's like, okay, so if we loan them 40 million bucks and the business, the private equity firm thinks is worth 100, the value has to actually decline to less than 40 in order for that loan to not be money good. So there's a substantial decline in value in that simplified example anyway, that has to take place. So that's just one example. And those are private funds that I alluded to earlier, but that's one example of, a current investment that we're making.
Fantastic. How can people find your content? I know I've enjoyed you and Paul chatting it up all about, selling of a business and the tax mitigation and that. You guys got some really good content out there, but if people are like, man, I need to it's like drinking from a fire hose, where can they find you? Where do you have content out there if they want to binge more of your knowledge?
Yeah. So, I put all of our stuff on LinkedIn, which I know a lot of folks aren't on LinkedIn. It's just, my name on LinkedIn, Nick Bartolo. But then I've also started Instagram and Facebook, just because I know, more folks are on those platforms. So anyone can find me on Instagram, Facebook, or LinkedIn. And then within those posts, there's always links to the full content. Or for instance, we just did this big private equity series in pest control, and we're also going to be doing one in lawn as well. And all of the links to the YouTube are contained in those various social media platforms. So yeah, check it out. And then again, if anyone wants to reach out, be added to the newsletter, feel free.
Okay. And it's Nick Bartolo. So it's Bartolo. Is that correct?
Yeah, correct. And, it's like, if anyone wants to reach out for either the newsletter or otherwise, you can just email me at nick@essentialp.com, or even, the company in general is info@essentialp.com.
Cool. Well, I really appreciate Nick, and thanks to JP for kind of helping to connect us. I was in his truck. We're going to dinner. He's like, I was talking to Nick today, and he asked me if he asked me if I'm going out to dinner with Paul. And I was like, I didn't tell him. And it's just a small little world.
Yeah, it is. I mean, hey, you guys were talking about it. I mean, I wanted to like get some more details about what you guys were chatting about. I feel like I was left out there. And so just turned on your YouTube, Paul, and I heard you guys were hanging out in Dallas. So, next time I talk to JP, I let him know.
Yeah, that was pretty cool.
Yeah.
Little connection there, but JP,
you guys are putting out awesome stuff. I mean, the stuff that you're putting out for business owners in lawn is just incredibly valuable. And shoot, Jonathan's Lawn Care Millionaire, and now what he's doing, more importantly, at 5 for 50 on YouTube. I mean, both of you guys, like, that's such an awesome way to give back.
Yeah, it's an absolute game changer. And in about 2015, 2016, I found his videos on YouTube and I just started binge watching. And I learned so much about business. And there's so many things I just implemented right away that was a game changer that moved the
Mhm.
needle in my business. And then years later to get to connect with JP in person and you know, the fact that he's doing it again in a more excellent way with good audio, good video, but just the knowledge that he's pouring out, it's absolutely fantastic. I wish I would have found his information sooner, but he's such a blessing to the lawn care world of
Oh
what he
yeah.
shares. It's like going to
Mhm.
college. So it's awesome.
Yeah, and you still have me thinking about Equip, getting out there to Equip to seeing you guys. I'm gonna be at the NALP, but I didn't realize Equip when we first booked NALP, but I still might shoot out there for a day.
Yeah, it's the biggest trade show in the lawn care landscape in space. There's 27,000 folks there last year, when I talked to Chris Kaiser, the president of the Outdoor Power Equipment Institute, a couple weeks ago, he says ticket sales are 75% higher than they were last year. So they're gonna shatter the attendance record
Wow.
this year. And we're gonna be doing a podcast on Thursday in the main ballroom in the main day on the main stage. And JP is going to be up there with Naylor and I. We're going to be doing a podcast, and it's been standing room only the last 3 years. So I'm expecting again, it's just we just pack out the main ballroom and do a podcast from the stage on Thursday, October 17th. But I know JP will be there Monday, October 14th, 15th, 16th, and then I think he leaves the 17th, maybe that afternoon. But he's going to be around if you guys want to come hang out with him. He'll be at the LCR
Yeah.
Summit and then Equip Expo. So.
Yeah, that's gonna be great. People are gonna love that.
Yep. Well, Nick, this has been very, very helpful. I'm very thankful that you were able to explain these complex things in a way that I think most folks can digest. Hopefully, they'll take action and get their, if they don't already have their $7,000 in for a Roth IRA. This will be the year you start, and one day you'll look
Do it.
back like I remember some Nick guy telling me, and
Do it. Yeah.
bucks.
Do it.
Cool. Well, thank you
All
so
right,
much,
cool.
Nick. And hopefully, whether it's at Equip or some other event in the future, we'll get you on in person.
Yeah, let's do it. That'd be fun. All right, Paul.